Thanks a lot, Nadine. Let me just share my screen. Great. Yeah, good morning, everybody. Thanks for inviting me to the series, and welcome to the talk. I want to talk about the role of finance in sustainability transitions today. By finance, I mean financial capital, but also the role of the system, the financial system that allocates this capital. For long transition frameworks, they included finance as a necessary resource, an enabler for transitions, but the precise working of the financial system and its roles for transitions have only been, I think, occasionally considered, and so I argue that we need more work on this. And I'm very happy that I get the chance today to pitch that to the NEST network. I want to start with discussing why finance matters, in my view, for sustainable transitions and sustainability transition. So for transition, which are these characteristics of being very fundamental and long-term changes of socio-technical systems. Then second, I want to make the case why I think transition studies specifically and the lens that we take in transitions studies can help to understand the role of finance. And finally, present a bouquet, I would say, of empirical insights on finance in transitions, which is to a large extent quantitative work as we do in our group, but that shows pattern that with some exceptions, have not really been conceptualized yet in transition frameworks, and I think pose interesting questions which could potentially be answered by transition scholars. So in that sense, I hope this presentation also be some food for thought. So let's start with why finance matters. And I want to focus on the low carbon transition here, the transition technique climate change. Though most things that we mentioned, they also translate to other sustainability transition. One could think about the circular economy, for instance. So talking about climate and the climate change mitigation transition, the underlying reason why finance matters is that to avoid the disastrous consequences of climate change, of course, we need a rapid and deep reduction of CO2 emissions. And that means that essentially we have to replace much of the existing energy system. Only then, as the energy system stands for really aligned share of greenhouse gas emissions, we will be able to bend the emission curves to the degree necessary. And building this massively different energy system, that requires investments which need to be financed. And the amount of capital that is needed for that is immense, as I think, at least for three reasons. The first one is in the nature of most sustainable energy technology, and namely that they are inherently very capital intensive, and more so capital intensive than most established fossil fuel-based solutions. If you look at solar photovoltaics, for example, from an economic point of view, you have a substantial cost for equipment, buying modules and inverters, also for construction, installing them, which is all upfront investment. And once the plant is connected, there's very little operational cost, doing a little bit of accounting, maybe a little bit of maintenance, but the cost really is upfront. It's in the upfront investment. And that is different for fossil fuel-based plants, where you also have to pay upfront for construction, but then also pay continuously during the operating phase for whatever fossil fuel you burn, be it gas, oil, coal. So the cost structure looks very differently. That's what I put on the right-hand side here. So for renewables, sustainable energy technologies like solar and wind, really the cost is made up of the capital investment, the CapEx, and the financing cost. To finance these investments, cost of equity and cost of debt. That's the first reason why I think finance matters for transition to sustainable energy technologies. The second reason why we need substantial capital, financial capital, is that many of the solutions that we see for sustainability challenges are novel technologies. And novel technologies, they tend to be really expensive and then only get cheaper along a learning curve once they are being deployed. So if we talk about solar PV again, that's the chart you see on the right-hand side. Probably everybody knows it's technology where costs decreased dramatically, more than 99% since the 1970s when it was first used at super niche applications in space. Same is true for wind turbines, biogas plants. There's plenty of studies in the transitions literature on that. And for sure, we will also see that for upcoming technologies like in the hydrogen economy, battery electric trucks, CO2 direct air capture plants. That's some pictures I put here. These are technologies which will also exhibit a learning curve. But until these technologies have become mature, the early investments are really expensive. And capital is needed to buy down the learning curve. And that's the second reason why massive investments are needed for the sustainable energy transition. And the final reason I want to mention, the third one, stems from where we are on the timeline of this transition and of climate change mitigation, where we have the situation that a lot of infrastructure will actually have to be replaced before the end of its normal technical and economic lifetime. It's unfortunate, but climate action has been delayed so much over the last decades that now in many cases investments into sustainable energy technologies will have to happen before the fossil incumbents reach retirement. For instance, many comparably young coal power plants in the EU. So we have to build infrastructure on top of that, which adds to the investment needs. For Europe, we try to quantify the infrastructure investment needs, just to give a few numbers here of the energy transition and put it in perspective to the current investment landscape. And I think this highlights two important things. So one, as one could expect from the capital intensity, there's a steep uptick needed in investments. What would be needed? For instance, what's shown here for the EU's Fit for 55 targets, essentially a path to net zero by 2050, where we estimate that investments would have to reach very soon about 302 billion euro per year in climate relevant infrastructure. And that's a jump by 87 billion per year, or 41% compared to the previous 5 years. So a steep uptick is needed. But second, it's not just more investment is needed, but we also see a shift between subsectors, which requires a redirection of investment. For power plants, that means much less investment in fossil fuel-based power plants, more in renewables, but also on the energy network side, for instance, we need less in fossil fuel networks and more in electricity networks. This kind of redirection comes on top to the general increase in investment. So that's the transition of the allocation of financial capital that's needed. The question that I want to at least briefly answer now from my point of view is how thinking about socio-technical transitions can help in understanding the role of finance and the financial system in that regard. And my starting premise here is that financial capital is not something that is instantaneously allocated to newly appearing technologies through fictionless capital markets, then we would have no problem. But it's actually something that's allocated through a financial system. So if you think about very simple economic models, we have households and companies. Households, they provide labor. Companies need labor, and then they produce things that the households can consume. And if you think about financial flows, we have financial flows. Companies pay wages to households. Households pay for the goods and services they consume. And importantly, we also have financial flows for investments, right? Could say households want to save and companies want to invest into new machineries, new software, and new innovations. But the allocation of these financial flows for investments, so the savings turning investments. This is not just payment through a payment system, like maybe wages or payments for consumption good, but it is something that is allocated through a financial system. The financial system have to make sure that the size of savings and investment is matched, right? So the typical household saves much less than, for instance, a new factory would cost. So we need a matching and transformation of sizes of financial capital. The financial system has to transform the maturity in many cases. So for how long households like to save, or for how long investments are being needed, and also risk profiles. So it plays an important role in the economy, and even more so if we also consider the government in a model, like an economic model as shown here, which also has a financial flow to households and to companies, and from them taxing households, taxing companies, and consuming goods from companies, having transfers to households. But importantly, the government also has financial flows for investments and to take on savings from the households. Government debt plays an important role. The central bank, through its monetary policy, plays an important role, which always goes through the financial system. So that even more underlines the importance of the financial system. In the financial system, this blue box, if you zoom in there, this is a system that consists of many different actors. For instance, financial intermediaries such as banks, commercial banks, investment banks, non-intermediaries, other financial institutions, pension funds, for instance, credit unions, one could say. That's a system that relies on institutions, such as financial markets, capital markets, most importantly, and also infrastructure. And as we know from studying the transition of socio-technical systems, in situations where we have actors, institutions, and infrastructure, we should expect all types of path dependencies, system-level dependency, nonlinear dynamics. So all types of challenges to an instantaneous allocation or reallocation of financial capital in that sense. So a system that needs to be understood. Some early work on conceptualizing the financial system in transitions by Anna Geddes and Tobias Schmidt, also from ETH Zürich, considered, that's what I show on the right-hand side here, finance as an overlapping regime. So it's a regime that overlaps with the other more socio-technical regimes, let's say energy, the energy regime, for instance. And technological niches, niche technologies, they interact not just with their technological, socio-technical regime, but also with the financial regime. And as some empirical work looking at state investment banks showed, these technological niches, they can interact with the financial regime in pretty much the same ways as they also interact with the socio-technical regime. That is, they can fit in and make the niche conform to the financial regime, or they could stretch the regime and try to transform. So that's some initial conceptualization that I find helpful. But of course, it explains part of the story. It talks about technological niches, how they interact with the financial regime, but also the financial regime itself. There's niche products, niche services within the financial regime, which potentially could also change the financial regime at large. And that's something which I think has been little studied so far and deserves further attention. And one approach to do so, to structure the thinking there, is to apply a lot of the elements, the categories that we know from transition studies, socio-technical systems, mostly large technical systems, where they have been developed, as they also play a role for financial systems. It's not just copy and paste, I would say, because the financial system in some regards is different than socio-technical system, but still they provide a lot of value, I think, in structuring the thinking about elements of the financial system. So what I show here in like a quite simplified form on the right-hand side, it's from studies 2 years ago, that tried to synthesize findings from pretty much what has been out there in finance and transitions at that point in time. So if you think about actor networks, for instance, this is something where for socio-technical system, often these are really large. They span entire value chains. Let's think about the European automotive industry, for instance. In the financial system, in many cases, the networks are super important, but they are also small, sometimes very small, and relatively closed circles. Think about the project finance industry, for instance, right? So teams that structure syndicates for infrastructure project finance in Europe, this is a handful, maybe 2 handful of financial institutions, which then have teams of maybe 20, 30 people. And that's all which are active in the case. So much smaller and much more closed circuits in many cases. If we think about institutions, in socio-technical systems, these are generally considered very stable. Often you need exogenous shocks from the landscape to change the institutions. This is all that the multi-level perspective is about. Whereas in finance, in general, I would say institutions, they are more flexible. And change is often also driven by crisis from within the financial system. So it's not just a landscape shock, but it's a crisis within the regime, within the financial system. And much of the transition literature on finance actually is about such crisis in the financial system and what they mean for that. So that was, for instance, the financial crisis 2008 and 2009, which caused much change in the system. Then again, the euro and sovereign debt crisis, which changed the role of the central bank, like a major institution, the financial system a lot. So that's one key difference there. Talking about routines in socio-technical system, they're strongly determined by the technology, obviously, and manifested in artifacts, and by extension, then also quite stable in many cases. Whereas in financial systems, it's really the networks that determine the routines. They're relatively easily adaptable, and as it happens in networks, we have different type of challenge here, I would say, except instead of being like very stable and hard to change, we sometimes have the occasion that some actors change their routines and then everybody imitates them. And so we have these herding effects, which are very typical for financial systems, and which pose different types of challenge. If we think about tacit knowledge, this is something in socio-technical systems, something that can reside in people, let's say engineers, in artifacts such as manufacturing equipment, for instance, or organizations, firms. Whereas in financial systems, this really is in people. Typically, investment offices, for instance, those structuring project finance deals. This is something which mostly matters for empirical research methodology, I think, because you have much less data sources. It's really the people in these closed circuits that you need access to in order to understand the tacit knowledge and the role of tacit knowledge in a certain area. And finally, path dependency, which is like a typical challenge being studied in transition and how to overcome that. This is something which in socio-technical systems is very important. Think about an oil major company, for instance, which worked in exploration and production of fossil fuels, where it's really hard to change that path, given technological trajectories, but also knowledge and institutional trajectories. Whereas in finance, there's also path dependency, mostly about knowledge trajectories, but to a less important degree. Compare the oil major that I just mentioned, for instance, with an investment bank that structures project finance deals or syndicates issuances of bonds and stocks. Whether they do that for sustainable energy projects or companies or fossil fuel-based companies, there's certain knowledge which is specific to a technology or sector maybe, but in general, it's much easier to adapt that. So path dependency might be less acute. So much what I think I would like to mention on the theory side, and to also foster the discussion in the second part of the webinar. I'd like to move a bit, on how to potentially study these elements, which of course requires empirical work. And I want to give some examples from potentially interesting areas, very briefly touching upon some empirical insights from our group that potentially might inspire transition research. And I should say that the charts that I'll be showing there from collaboration with many colleagues, especially also many early career scholars, PhD candidates, master students. I won't always mention all names because it's just too many, but you will always see them in the sources of the bottom of each page. I want to start with an example where empirical findings inspired conceptual thoughts, and that is technology and financial learning, informed by the case of renewable energy technologies. And here our starting point was the finding that for renewable energy technologies, financial learning really played an important role in making them cost competitive and bringing them to the mainstream energy system. Because it was not just technology costs that went down massively, but also financing costs, so cost of debt, cost of equity, which went down substantially as these technologies matured, which was an important part why they actually became cheap and mainstream, given the capital intensity that I mentioned before. So on the left-hand side, you see some quantitative results of ours, especially the red lines, which shows the debt margin for solar and wind project finance loans. So that's what banks put on top of their refinancing cost for technology-specific risks, which almost halved over the study periods. So there was quite some movement, and on the right-hand side, we summarize some qualitative interviews we did to understand what drove this reduction in financing costs, and we found there was really a lot of learning going on in renewable energy finance. Experience that was gained with increased finance, both on a firm level, doing better due diligence, doing better technology assessments, better risk assessments, having standardized investment structures, and so on. But also on a firm level, also on an industry level, on a renewable energy finance industry level, with an investment ecosystem emerging and many new types of investors entering the market, especially investors with different risk return expectations. Investors being willing to take less risk, but therefore also asking for less return, so allowing for lower financing cost. So we saw with experience, renewable energy technologies became mature, not just from a technological point of view, but also financially mature from a financing point of view. And that inspired us to conceptualize a financial maturity of technologies on top of technological maturity. This is the ongoing work. building on technology innovation system, TIS, and financial development. We derive what you see here, a couple of indicators how you could measure the financial maturity of technologies on the level of financial networks, on the level of actors, and suggesting that we have 6 dimensions that matters. It's about the depth, financial depth, so how liquid is a financial sector, what's the varieties of actors in a sector. Concerning the access, which is about openness of network, and then accessibility of knowledge for new actors in the network, and then finally efficiency, how fast capital circulates, and eventually how the financing costs look like. So we propose a scheme of measurement for financial maturity, but of course there remain many open questions. How does financial maturity conform to technological maturity? Under which instances do we see structural breaks between the technological maturity and the financial maturity? When could finance be a bottleneck? And how to potentially accelerate, which is all topics that mandate further research. Second group of examples is some interesting findings where conceptualization is still pending with respect to the actors that are active. So one important finding on the left-hand side is, depending on the technology, we see different actors that are crucial for financing these technologies. So on the left-hand side, you see a split between corporate finance in gray, where it's essentially the corporates that finance new technology assets on the balance sheet, and project finance in blue, where banks play a much more important role. And you see for renewables, this seems to be much more the case than for fossil fuel-based technology. So banks become much more important for some technologies than others. On the right-hand side, it's a deep dive into one technology, offshore wind, where we see coexistence of project finance and corporate finance. And where we found this is really a technology where large incumbent players, be it either large utilities or large oil and gas companies with a strong balance sheet, seem to be super important. And so this, I think, poses many questions beyond quantitative findings concerning the role of networks, the role of path dependencies for the importance of different actors, and so on. To give another example, the role of institutional investors, I think needs further scrutiny. One example is pension funds that you see here, which typically don't go in very risky investments, so that's nothing to count on for new technologies, but something to potentially count on for the phase out of unsustainable technologies such as fossil fuels. And we see great heterogeneity. That's what this chart summarizes, to which extent fossil fuel pension funds divest from fossil fuels. So there's different dynamics between public and privately owned pension funds, between different types of private pension funds. And I think research could help to understand what drives these dynamics, how became a niche of the financial system, like the sustainable finance niche, in this specific regard, more or less mainstream, right? So there's half of all assets under management are now in pension funds that divested from fossil fuels. But also, how can we make sure that actually the niche then transforms the regime and not just fit in? Put differently, do we actually see an impact of such actions then? Or is there no impact at all? Is it just greenwashing once this sustainable practice becomes mainstream? So I think this is important questions for research. Finally, let me mention one natural consequence. If you have some doubts on the impact of transitions in the private sector, and that is to ask for public policy. and the potential role of the state in the financial system. We do see much momentum in financial policies, green financial policy making. So this is policies that somehow try to affect the financial system to redirect capital flows to sustainable investments, sustainable assets. This just shows the number of policies which went through the roof since the Paris Agreement. But many of these are rather minor interventions. And one bigger question, that's something that featured quite prominently also I found at the last IST conference in Oslo this year, is what is the role of the state, or what should be the role of the state in financing sustainable infrastructure? We do see empirically the state being important for very new technologies, like building the very first wind or solar plant in a country. So there always the state has been important. But also for mature technology on the right-hand side, general investment in power generation. Empirically, there is a tendency that state-owned utilities, they invest to a larger degree in renewables compared to privately owned utilities. Though our empirical research suggests this really, we see in cases where things come together, public ownership and climate policy ambition and good quality of governance. So this doesn't say that public is better than private per se, but it rather says if you have public players, you can use them to steer finance in a certain direction. But there's many trade-offs involved, and these I think definitely need further research. One specific case, just to wrap up, to mention, which has studied quite a bit, is green state investment banks and which role they play specifically for new tech. So this is public banks, publicly funded, however, with an independent day-to-day operations that typically invest alongside private actors. And quite some research showed that these banks, this is one public intervention that can actually have quite an impact on mobilizing private finance also and in transforming the system. By being a first mover into new technology, signaling that technologies are viable for investment, educating the sector, they can make a difference. We have recent work that tries to scrutinize theoretically how they can make a difference, solving the cooperation and coordination problems we see in financial markets. And also empirically, there's increasing work, including from us, that's what you see on the right-hand side here, but also by other teams, that show generally state investment banks, they have a higher involvement in higher risk technologies, such as offshore wind. You see some 70% of deals, including such banks. And decrease the activity once technologies become more mature. But there's some contrasts to what the transition literature at least would suggest, especially state investment banks. They do not show increased involvement in very first project using a novel technology. And I think there more research is needed to understand what's also the role of state investment banks, maybe as compared to other public actors that you also have in technology finance sphere. So to conclude, I hope it got across that I think financial capital matters for sustainability transition. So we need to understand the financial system. Hopefully the sustainability transition lens can help to conceptualize the role of the financial system. And I believe the quantitative findings that we have and that increasingly are produced and presented by many groups, they can serve as a starting point for exploratory and explanatory research, also qualitative research that try to make sense of these patterns, for instance, through comparative case studies. And with that, thanks a lot for your attention, and looking very much forward to any question and discussions.
Thank you very, very